Have you ever wondered why the smartest people you know always seem to sell crypto at the exact worst moment? Not beginners, not tourists. I'm talking about engineers, analysts, doctors, founders, people who understand data, risk, probability, and yet they panic sell bottoms like clockwork. This isn't about intelligence, it's about something much deeper. Today, I want to decode why smart people panic sell crypto at the worst possible moment. And if you stay until the end, you'll probably recognize yourself in this story, because this pattern repeats every single cycle, and most people never see it coming. Let's start here. Crypto doesn't punish stupidity, it punishes certainty. And smart people love certainty. Pause on that. Now let's break this down. Number 1. Smart people confuse understanding with control. If you're intelligent, you're trained to believe that understanding something gives you power over it. In school, that's true. In careers, that's mostly true. In traditional finance, it often works. But crypto is different. Crypto is not linear, it's not polite, it doesn't reward credentials. Bitcoin doesn't care if you've read the white paper. Ethereum doesn't care if you understand gas fees. The market doesn't care if you did everything right. Smart people do deep research. They read reports, they model scenarios, and then they expect the market to behave logically. But crypto markets don't move on logic, they move on reflex, fear, liquidity, narratives, leverage. So when price starts falling fast, smart people don't think this is volatility. They think something must be wrong. They assume the drop contains new information they missed, and that's the first crack. Because the moment you believe price knows something you don't, you stop trusting your thesis. I've seen this happen so many times. Someone buys Bitcoin at 45K. Not emotionally, rationally. They say, I'm holding for 5 years. Then price drops to 38K. They're calm. Then 32K. They reread articles, they open Twitter, they see confident voices saying, this time is different. And suddenly, their intelligence turns against them. They start building reasons to exit. Not emotional reasons, logical ones. That's the trap. Number 2. Smart people are better at rationalizing fear. This one hurts, because intelligence doesn't make you less emotional. It makes you better at explaining your emotions. When crypto crashes, fear hits everyone. But dumb fear sounds like, I'm scared. Smart fear sounds like, the macro environment has changed. It sounds like, liquidity is tightening, regulatory pressure is increasing, risk assets are repricing. All true, all reasonable, and all useless in the moment. Because by the time these explanations feel obvious, price has already moved. Smart people don't panic sell screaming, they panic sell calmly. They tell themselves they're being responsible. I'll buy back lower, I'm protecting capital, I can't ignore these signals. But here's the uncomfortable truth. Most panic selling isn't about avoiding loss, it's about avoiding feeling stupid. Smart people are deeply allergic to being wrong, and crypto makes you feel wrong constantly. You can be right long-term and wrong for 2 years straight. That's unbearable if your identity is built on competence. So when price collapses, selling becomes a way to restore self-respect. You're no longer wrong, you're prudent. And that's why bottoms form when selling feels intelligent. Think about that. Number 3. Smart people overweight narratives during drawdowns. In bull markets, narratives are fun. Digital gold, banking the unbanked, layer 2 adoption. But in bear markets, narratives turn predatory. Suddenly, it's Bitcoin is too slow, Ethereum is too complex, crypto has no real value, and smart people listen. Why? Because negative narratives feel sophisticated, optimism feels naive, skepticism feels smart. So during crashes, the smartest voices get the most attention, not because they're right, because they sound careful. During every major bottom, the dominant narrative is always some version of this time is different. Different tech, different macro, different regulation. And each time it feels convincing. In 2018, it was ICOs collapsing. In 2020, it was a global shutdown. In 2022, it was leverage, contagion, and central banks. Each time, smart people said, "This isn't like before." And each time, it was exactly like before. Volatility shook out weak hands, liquidity reset, conviction transferred. The irony? By the time narratives turn positive again, smart people re-enter at higher prices with less confidence. Number 4, smart people underestimate time more than risk. This one is one of the most dangerous blind spots. Smart people are trained to manage risk. They diversify, they hedge, they size positions carefully. But crypto's real risk isn't price, it's duration. Can you hold while nothing happens? Can you hold while everything looks broken? Can you hold while people you respect are bearish? Most people can't. And smart people struggle even more because they constantly reassess. Every month, they update assumptions. Every quarter, they reevaluate. That sounds wise, but long-term crypto investing requires something counterintuitive. You need fewer decisions, not better ones. Bitcoin didn't reward people who optimized entries. It rewarded people who stayed. The hardest part isn't buying, it's not selling. It's holding through boredom, embarrassment, and doubt. Smart people feel obliged to act. Doing nothing feels irresponsible. So when crypto goes quiet, or ugly, or unpopular, they act, and action feels smart, until it isn't. Number 5. Smart people anchor to their entry price. This one is subtle and brutal. Say you bought Bitcoin at 60K. Price drops to 30K. Your brain doesn't see opportunity, it sees failure. You're down 50%. Every decision feels poisoned by that number. So instead of asking, "Would I buy at 30K today?" you ask, "Should I admit this was a mistake?" And selling becomes emotional closure. Smart people hate unresolved problems. A losing position feels like an unfinished sentence. Selling ends the discomfort. But markets don't care about your entry. They care about supply and demand. The best long-term entries almost always feel terrible in the moment. They come when confidence is lowest, and smart people struggle most right there, because buying feels dumb, holding feels reckless, and selling feels rational. That's why bottoms are lonely. Now let's zoom out. Crypto cycles are psychological machines. They don't test knowledge, they test temperament. Every cycle follows the same emotional arc: disbelief, optimism, euphoria, anxiety, denial, fear, capitulation, silence. Smart people usually enter during optimism, they exit during denial or fear, and they swear they'll do better next time. But next time feels different, because next time is you, right now, watching this video. Maybe you've already sold, maybe you're thinking about it, maybe you're holding and questioning everything. That's normal. The market is designed to make you uncomfortable. If it were easy, everyone would win. So what's the lesson? It's not never sell. It's not always hold. It's this: if your conviction disappears during drawdowns, it was never conviction, it was comfort. Real conviction is quiet. It doesn't argue on Twitter. It doesn't need constant confirmation. It survives boredom. It survives doubt. It survives looking wrong. The smartest crypto investors aren't the ones with the best models. They're the ones who understand themselves. They know when fear is talking. They know when narratives are noise. They know when doing nothing is the hardest move. So before you make your next decision, ask yourself one question: am I reacting to price, or am I reacting to how price makes me feel? That answer will tell you everything. If this video made you think, you're already ahead of most people. Stick around, subscribe if you want more calm, honest crypto breakdowns like this. And remember, markets don't reward intelligence, they reward patience.